Welcome to the 6th episode of the Sydney Contrarian, titled The Runaway Bank Stock Prices. Do the revenue and profit figures stack up? Now, I have not made an episode for over a month because there's been quite a number of things that I was attending to. However, I am back, and hopefully in time I can get myself back to speed with more videos. This video, I spent a lot of time doing the numbers and analyses, so hopefully it is worth the wait. As this video goes on air, we have just passed the 8th anniversary of the bottom of the equity markets on the 6th or 9th of March 2009, depending on when newspapers were publishing headlines saying whether the end has come for equity markets. Interestingly enough, when the mainstream media publishes headlines on how equities or any asset market is the best thing since sliced bread, then you know in hindsight that you probably reached the peak in markets. And in the case where they're publishing whether the market is now dead and buried, and whether it was the worst thing for you to have purchased these assets in the first place, you know that the market is pretty much at its bottom and it's time to pile in. Now, fast forwarding from these dark days for many investors, we are now seeing how if you had held Big Four bank stocks in Australia during this period, you would have done quite well. In fact, you would have done marvelously. If you actually ask people these days what stocks they own, if they actually do own any stocks, they would tell you by default that they own at least one or more of the Big Four bank stocks in Australia, namely those of Commonwealth Bank or CBA, Westpac St George Bank, the National Australia Bank or NAB, or the Australian New Zealand Bank ANZ. There's a reason why so many shareholders own bank stocks. After all, they do make up a substantial proportion of the entire market. To put into perspective of the scope of these Big Four banks in the market, their combined market capitalization is $440 billion. This is almost 25% of the Australian Stock Exchange. And they generate annual profits in 2016 of $29 billion. This figure is large enough for them to be actually the 10th largest company on the ASX. And if you ask them why they hold these stocks, the most common answer they give you is that, hey, bank stocks are great and banks cannot fail. If you look at the headlines in the news, you will be forgiven to believe that this is a complete truth. However, at the Sydney Contrarian, we do not just take the news and accept it as gospel. In fact, often, the more the news agree with each other, the more suspicion I'm going to have. And having spent some time looking at the figures underneath the surface, my suspicions are confirmed. So buckle up, as we're really in for quite a ride. But allow me at this point to state that I do not hold any bank stocks and I do not intend to. Also, what I say in this video should not be taken as any professional financial advice regarding bank stock investments or any other form of investments. I state my opinions only, but you need to do your own research and consult a professional before making any investment decision. So let's have a look at some of the headlines on how bank profits are breaking records. They have actually splashed across many news websites, being on the TV news, and also in the headlines on the newspaper in the front cover over the past 6-7 years. You may be so used to them that they don't catch your attention anymore. However, if you read them, and you should, you'll notice that the tone is pretty much the same. That bank profits breaking records are a great thing. You'd almost think that you're reading about Olympic athletes beating world records because they seem to be writing in the same tone as the Olympic Games. So here's one from Yahoo, written by Chris Pash on the 7th of November 2016, titled, "The record profits at Australia's Big Four banks have ended." The article talks about how the Big Four banks have ended their stellar run on record-breaking annual profits, and discusses the factors leading to banks no longer being able to deliver record growth going forward. The tone of this article provides little in terms of an ominous warning, although if you read closer, you will actually find that it's quite alarming. Let me highlight some of these factors. For example, it's said the banks have been hit by a combination of bad loans from a series of corporate failures, low interest rates, a squeeze on net interest margins, losses on sales of assets, and a cost of restructuring. This is not good news. In fact, it's really bad. Bad loans are basically loans that banks have made to customers, whether it's retail or business, and they don't expect to receive the repayments in full. With regards to corporate failures, Australia has actually experienced almost a record number of small businesses failing in the last year. The most important predominant ones include Dick Smith Electronics, Pumpkin Patch, Payless Shoes. Furthermore, many jobs were cut from major companies across different industries, leading to weaker consumer confidence that feeds into the economy in general. And we also see them mentioning low interest rates and the squeeze on net interest rate margins being the cause for banks to report weaker profit growth. You may want to refer back to episode 1 for more information about how low interest rates are harmful to the economy. But what's important to note here is, hey, they're saying there's net interest margin squeeze on banks. But if you go back to episode 1 and 2, I've talked about how banks actually have been making record profit margins on the difference between interest rates that they charge on lending to customers and paying to those who save using savings deposits. So something is not really adding up, or you could probably say that, oh, banks are currently now no longer making such a fat margin, which in the first place was not really called for in the first place. Now, the other thing that I also should note here is, with low interest rates, remember that businesses also engage in investing in more projects instead of holding back cash in a low interest rate environment, because they can't find a compelling investment opportunity. If in a higher interest rate environment, then they can just let the cash sit there. But in a low interest rate environment, even if the investment project is not compelling, they're going to still have to invest, because there would actually be very little incentive to leave it in a bank that pays interest at a minimal rate of 1.5 to 2%. Now, Chris talks also about the cost of restructuring affecting bank profits, as banks have been cutting jobs and having to pay redundancy packages to those that they actually sack. But wait a minute. Didn't these banks record growing profits year after year? If that's the case, why are they sacking staff? If they're doing well, shouldn't they be growing? Oh, wait. The staff salaries are probably dragging down their growing profits, so they may just have to cut down on staff, maybe hire people from Southeast Asia on a lower salary, in order that they can report higher profits to grow their management salaries and bonuses, and also keep the shareholders happy. Now, in this article, it's also mentioned that the Westpac CEO Brian Hartzer states a bank's return on equity target of 15% that they used to set is too high, and maybe 13 to 14% is a more reasonable new target. The reason for that is bank profits are dragged down by bad loans. But that's alright, not to worry. As long as they can earn 13 to 14% return on equity by writing more loans to people and paying savers less, then they can probably keep that 13 to 14% level, and everything's just absolutely okay. There's no moral problem with it, and customers just won't notice the fact that they're getting ripped off. Or maybe they should actually notice something is wrong. The second article that I'm going to quickly review focuses on the largest bank in Australia, the Commonwealth Bank of Australia. The Associated Financial Press reported on the 15th of February 2017 that CBA reported another record-breaking profit for the first half year of 2017, with a profit after tax of $4.9 billion that was 6% higher than the previous half year. The CEO says that the success lends itself to a more conservatively managed balance sheet and spending as it navigates market volatility. To the Sydney Contrarian, it reads that the success spans from knowing how to rip off customers who deposit their savings by paying them lower interest rates and then charging borrowers increasing rates on loans to businesses and customers, especially those who are actually getting a mortgage on their property. And to manage spending, they have decided to give their staff less pay increases relative to how much revenue growth that they've generated, and the sack and tie teams have shipped them overseas to reduce local headcount in order that existing staff are paid less, work harder, and there's less efficiency, which we are not going to see in the short term until they realize the teams that they've outsourced overseas are going to bite them back in the backside later on. Now, inherently, there is something wrong with these news articles whenever they cover how bank profits are breaking records, almost in the same tone that they're talking about Olympic athletes, is that you should think about it. No company should be really lauded and congratulated for making long-standing record-breaking profits. Because if you think about it, where did these profits come from? They're from charging a much higher price on the customers for goods offered and services provided. Who are the key customers of banks? Well, the answer is us. And most of us are going to use banking services. So everyone is paying more to basically line the pockets of management and perhaps some of the shareholders. But why are we contributing to making record profits for them when we could get the same product or service for a lower price that everyone can actually benefit in society? I'm not saying this from a socialist point of view, don't get me wrong. I'm not saying that if you make a big profit, you're an evil person. But what I'm saying is, what is the benefit of charging much higher prices for providing services that everyone needs in order that you keep making record profits year after year? To extend this further, the big four banks already form almost 25% of the entire Australian stock market by value. So each time they're breaking records on profits, that's a substantial dollar amount we're talking about. And it really just shows how much customers are getting ripped off. How is it cause for us to celebrate and applaud their performance, whether we're shareholders or not, because we're actually paying through our nose to help these people, to help these management benefit? I just don't get it. Third article that I'm going to cover is from the Daily Reckoning Australia website. I highly recommend you visit this site as it provides you a sobering perspective on the state of the global and Australian economy, while explaining to you some of the processes in order that you understand more about what is going on. In fact, this website, the Daily Reckoning Australia, is where I get a lot of insights that develop the way I think about the Australian economy, the global economy, where to invest, and what's actually the processes that's driving the financial markets, the economy, and sometimes even politics. Vern Gowdy writes good articles, and he also has some books on investing to protect one from an increasingly dangerous economy. In his article, he offers a blunt commentary on the dire situation of a debt-driven global economy, of which Australia is a very dangerous example. Some of the highlights of this article includes the following. The falling savings ratio prompted Bloomberg to issue this headline: Aussie consumers are putting away less for a rainy day. We're mortgaged to the hilt. We haven't had a pay increase. Part-time employment is on the rise at the expense of full-time jobs. And the cost of the non-negotiable budget items, energy, water, rates, and government charges, keep increasing at a faster rate than the official consumer price index figure. For many households, this is not a rainy day. It's a tropical storm. Households are drawing on savings to maintain the lifestyle we've become accustomed to after 25 years of being recession-free. Now, I want to emphasize on how Vern points out Australians are mortgaged to the hilt and they have not had a pay increase. In a way, most Australian workers experienced a pay freeze for a few years after the 2008 subprime crisis. When their pay rises resumed, inflation had already overtaken them, and we're not talking about the fake CPI data that says prices have been rising at around 1 to 2% per annum because they just don't really count on food, petrol, and housing costs. They also make adjustments to what defines the goods in a typical basket of goods that's purchased. So households cannot save if they're paying more on necessities unless they rely on borrowing to maintain their living standards. Furthermore, it doesn't really help when TV ads, billboards that you see in the roads and shopping centers, and the media pop culture continually spew torrents of consumerism to keep many thinking that they are cool if they get the latest gadget, fashion, or they spend up going on holidays. How do they help people save up if they're just spending every dollar that they earn and more? The story is actually more cruel when you think about it if you include the fact that banks are helping themselves in this particular situation by dangling in front of us easy to access credit to get people to spend more to impress people they don't like by getting things that they don't need, and then paying banks more interest in the same time. So Vergadi also writes, the banks are entering into a credit card war, offering plastic with lower interest rates. These bank executives aren't stupid. My guess is that the boardroom thinking went something like this. Rising household costs, increased mortgages expenses, no pay rise. Well, we think people are still going to want access to low-cost unsecured finance to maintain the facade. Let's drop the rate on credit cards and watch outstanding balances balloon. And let's bring in the spin doctors and tell the brainwashed credit-dependent consumers that we are being good corporate citizens by making credit cheaper. So in a way, bank stock investors are not wrong. Given that we have seen Australians being further driven into debt and banks are earning more interest, maybe to help them a little bit to offset the massive debt they've got and the growing interest bill that they have to pay, buy bank stocks because they're going to deliver growth, right? Well, let's actually go underneath the hood and see the financial results of these big four banks and decide for ourselves whether that's actually justified. So I analyzed the stock price history of the big four banks and compared it against the total shareholder returns over the past 10 years from January 2006 to December 2016. Now, the total shareholder return is the increase or the decrease of the stock price over the 10-year period plus returns generated from dividends that are paid and then immediately reinvested to purchase the stocks. So as you can see, Commonwealth Bank of Australia has clearly led the field amongst the four banks by a phenomenal increase of around from $28 in 2009 to $84 now. Coming second is Westpac, that's currently trading about $34, increasing from the mid-teens in 2009. The third largest bank in Australia, ANZ, has been trading just over $31, almost tripling its price since 2009 when it traded as low as $12. And finally, NAB trails the pack. It used to be the largest of the big four banks, but due to a few banking scandals in 2004 and some poor business decisions being made since the subprime crisis, they've actually fallen to last place and they're trading at $32, having recovered from early 2009 when it traded around $15 to $16. Now, if you look at the price of the first pitfall that people would fall into when they make decisions on investing in stocks is to look simply at the stock price history. Banks do pay substantial dividends during the period, ranging from about 5 to 9% per annum of its share price. On average, banks have actually been paying 7% dividends. So if you include that, you can see how much an investor of these bank stocks would have earned. CBA investors, if they put in $100 in their investment in 2006, they would have watched $100 become $433 at the end of the 10-year period, at the end of December 2016. Westpac investors would see it go to $339, ANZ $281, and NAB almost $230. So basically, bank stock investors would at least double their investment over these 10 years, even though they would have faced some heavy losses during the subprime crisis. But as long as they did not sell during that period, they still reaped pretty good rewards. Now, many investors would consider past investment performance and presume that this would be an indicator for future performance. That's why they're saying, hey, bank stocks have been doing really well. That's why I'm buying bank stocks, and that's why I'm going to hold them even if it falls, because it's going to recover. But this is a dangerous assumption. In fact, future investment performance may sometimes be inversely related to the past. A company that has performed very well over a long period of time may also experience a slowdown or even a reversal in its fortunes in the future, depending on whether investors got ahead of themselves relative to the company's fundamental prospects or its capability to generate future growth as it has in the past. So what determines a suitable price growth and shareholder returns relative to the company's growth? The answer is you've got to see whether the past growth potential is sustainable and possible in the future. And we're going to have a look at that in the next few slides. Let's look at the bank stock prices compared to the price to earnings ratio. Now, the price to earnings ratio is a rough measure of whether a stock is cheap or expensive by considering that if you paid to buy the stock now, how many years of its annual earnings would it take for you to earn back the initial investment? So technically, a higher P/E ratio means that it would take you longer to get back your initial investments from the company's profits, reflecting a more expensive stock or one where the pricing has gone ahead of itself. As the figure indicates, the stock prices for banks have been rising steadily and quite significantly since 2009, but more so for CBA rather than the big four banks, the other three competitors. The rise has also been noticeable from around January 2016 to the late 2016, just leading up to the US election. This was because the rate rise by the Federal Reserve in 2015 December sparked a global market correction, and the correction basically sliced a significant proportion of the stock price rises leading up to that time. But that was nothing compared to the recovery we've had since the US election last November to current times, when basically the markets have entered a euphoria mode, having believed that Donald Trump is going to go and reduce taxes, increase government spending in order to revive markets. Now, at the same time, I should also get you to look into the P ratio for the banks rising in the past 5 years, with the only exception being NAB. So this suggests while the banks are making record-breaking profits year after year, shareholders themselves have also gotten ahead by paying a higher price relative to the growth of the underlying earnings, and that is not necessarily good. Now, a P ratio of around 10 to 12 is considered relatively healthy from a value investor's perspective. Value investors want to buy stocks with low P ratios hopefully 8 or below, good companies with earnings that are sustainable, because this way, when the market re-rates this stock and realizes that they do have good investment prospects, they're going to buy back and bring back the P ratio to say around 10 or so level. So if a P ratio of a company stock is currently 6 and you buy it, and it turns out later on that the market decides that this company is actually quite meritable in its performance, and the P ratio goes up to 10, you as an investor would have earned 67% return. Similarly, if you bought a stock with a P ratio of 15 and the market later realizes it's overpriced and sells it down so that the P ratio is 10, you would lose 33% of your investment. Sure, the markets can get it wrong about a stock or the company itself, maybe growing into the future to justify a higher P ratio. However, all good things do come to an end, and the higher the P ratio, the greater the risk that you are getting ahead of yourself, and this is exactly what the market's doing. So at this point, let's look into the bank revenues and profits and see how the P ratio trends, to what extent it's reasonable. Now let's look at the underlying growth in bank revenue and profits and compare it against the stock price rising over the past 10 years. I have purposely not scaled these so you can see how the big 4 banks' performance compare against each other. As you can see, the revenues and net profit after tax for banks have undeniably risen over this period, though the profits have slowed down in the past 2 years for the 3 banks, with the exception of Commonwealth Bank. What is interesting to note is that the stock price does not seem to follow the growth in the revenues and profit after tax. In these last 2 to 3 years, the stock price appears to have retreated and gone against the trend. Over the past 10 years, CBA shareholders experienced a total return of 339%, while revenues grew 101% from $12.3 billion to $24.7 billion. Profits grew 134% from $3.9 billion to $9.2 billion. Westpac shareholders experienced a return of 239%, with revenues growing 128% from $9.2 billion to $21 billion. Profits grew 147% from $3 billion to $7.4 billion. NAB shareholders experienced a return of 130%, with revenues growing only 17% from $15.5 billion to $18.1 billion, and profits grew 46% from $4.4 billion to $6.4 billion. Finally, ANZ shareholders experienced a return of 181%, while revenues grew 102% from $10.2 billion to $20.5 billion, and profits grew from 55% from $3.7 billion to $5.7 billion. So in absolute terms, shareholder returns have overwhelmingly exceeded the growth of revenues and profits that underpin a company's performance. It should also be seen that this is also not a clear picture, since during this period, banks have sold new stocks and borrowed to make their operations bigger, and that way they can earn greater profits. Let's see how the results look when we adjust for this additional capital that they have deployed. We can now see more clearly to the extent to which shareholders have been buying bank stocks at a rate that outpaced the growth of bank revenues and profits when we adjust for additional shareholder capital. On a per stock adjusted basis on revenue and profit growth, CBA revenues only increased 51% and profits increased 76% over the 10-year period. For Westpac, revenues increased only by 25% and profits increased by 36%. For NAB, revenues actually decreased by 29% and profits fell by 11%. And for ANZ, revenues increased by a mere 27% and profits actually fell 3% over the 10-year period. Now let's look back at how much the shareholder return was and how much share price have risen over these 10 years. So banks basically grew in size through selling new stocks and borrowing from other institutions, and they're delivering less incremental returns to shareholders. However, shareholders have been buying up these new stocks and pushing up prices, most likely due to falling interest rates forcing people to take their savings out of the bank account and investing it into various risky assets to get a better return. While momentum in buying these stocks may confirm the view that these bank stocks are a great investment, is it really a good idea to keep investing into them? And this is a really perplexing question. So putting together the comparative growth of the bank's revenue and profits in absolute and per stock adjusted terms, we can see how stretched shareholder returns are relative to the underlying bank performance. This situation would potentially lead to a disaster for those who own bank stocks. Let me explain why. A large proportion of people are not familiar with investing, and they may not be able to accept the level of risk inherent in buying bonds, stocks, properties, and other assets. They would rather have put their cash in a bank account and earn a certain return, and that's what a lot of people have been doing. In the days of higher interest rates of at least 4% per annum, they would be able to save up, increase their wealth after adjusting for inflation, which is about 3% to 4%. I'm not talking about the CPI headline inflation. That's a misleading figure. But at least they would see a real growth in their purchasing power and wealth. But in the past 9 years, central banks have reduced interest rates and crushed savers as the return on their bank deposits dropped from below 3% per annum to as low as 1.65% per annum today. And inflation during this time, the true inflation, have remained around this level and have even increased a little bit in some cases. So to protect their wealth and retain their standard of living, a lot of people would gradually have to invest into riskier assets in order to earn a return that they can actually try to keep up with inflation. Bank stocks increased steadily and even quite remarkably during this corresponding period, so many would have found safety putting their cash there. Some also went and bought property and got funding from, well, you guessed it, banks. So banks then earn interest on their mortgages, which boost their revenues and profits. They pay lower interest rates on savers, and many people were herded into mortgages with them and buying bank stocks and becoming owners of them, making these banks appear to be the savior. But as we have seen, bank stock fundamentals, as reflected by their revenue and profit growth, have been slowing down and in falling considering the per stock adjusted basis. So banks have raised interest rates on mortgages recently and have now forced borrowers to pay higher weekly payments in order to pay down their mortgage. And alternatively, instead of that, they could actually pay the same amount and extend their loan for a longer time, and banks are going to reap more interest revenue along the way. So with banks further saying that they'll raise interest rates this year and going forward in order to protect their margin, and also because the government regulators are saying they need more capital in case people are not going to repay the loans, then they're going to actually have a good deal. Banks have already started raising fixed and variable rate mortgages since August 2016. And they have reduced interest on savings as the Reserve Bank of Australia have cut the 24-hour cash rate. So more people who have entered into the stock and property markets these days are lined up for the slaughter, reminiscent to the US subprime crisis that began in mid-2007. As rates rose back in those times in the US, those who borrowed faced rising interest payments that they could not afford anymore. And this is going to also happen to businesses that are heavily geared, and they're going to cut expenses by laying off jobs and selling assets and cutting down their business to cover interest payments. This is going to happen in the future. Mortgages, those mortgage borrowers and businesses could well default in the face of upcoming interest rate rises. And this is going to affect banks who are going to make losses on these loans because they had expected to get them back in their past revenue and profit forecast, and they're not going to get them. They're going to face losses. And if they report higher expenses, greater losses, and lower profits, then the stock price is going to fall on these banks. So the shareholders of these banks are going to make losses on their investments if they had purchased in recent times. So think about the case of how many investors these days not only have a mortgage, but also hold bank stocks as a predominant part of their portfolio. Can you see how they'll be doubly burnt when things come around? Well, many do not see this coming because it has not arrived and it hasn't been for a long time. History will repeat itself. We have seen it in Japan in the late 1980s to early 1990s. We saw it in the United States and the European Union in the subprime crisis. The question is, will you consider trusting your investment in bank stocks and properties and once again believe that history can be defied, and also you're not going to believe in the hard data from the analysis that we've covered? Well, that's it from the Sydney Contrarian. Stay tuned for a future episode, and once again, God bless.